Have you ever wondered how finance went from trying to predict stock prices with these really neat, clean equations to suddenly sounding the alarm about global meltdowns? It's a huge shift, right? Well, that's the journey we're going on today, from the elegant theory of market equilibrium to the much messier, much more complicated reality of systemic fragility. So, that's the big question we're tackling. How in the world did the study of finance transform its focus from just pricing risk on a spreadsheet to trying to predict the next big crisis? Let's dig in and unpack that evolution step by step. All right, here's our roadmap. We're going to walk through this story in 6 distinct parts. Think of it like peeling back the layers of an onion, where each layer reveals a more complex and, frankly, a more dangerous financial world. So, let's start at the very beginning. The original ambition of modern finance was huge. It was this grand idea. What if we could create a single, unified theory of risk? A mathematical framework so precise that capital would just flow perfectly to where it was needed most. And the first massive breakthrough was basically turning risk from a gut feeling into a math problem. Instead of just telling stories about a company, you'd calculate its variance. Instead of relying on intuition, you'd measure covariance. The goal was to tame risk, to make it something you could measure, price, and ultimately something you could control. The dream, really, was a perfectly rational market, a beautiful, self-regulating machine where every single dollar flowed to its most productive use, almost automatically. It was an absolutely elegant idea. But as it turns out, it was also incomplete. You see, the real world is messy. It just didn't fit neatly into these clean models. So a new question popped up. If markets aren't actually in a perfect equilibrium, what is it that keeps them in check? What keeps them from flying completely off the rails? So the big pivot was to move away from trying to guess what every single investor wants, which is pretty much impossible. Instead, the new idea, arbitrage pricing, focused on a much simpler rule. You can't get something for nothing. If 2 different assets promise the exact same payout, they have to have the same price. It was a much more practical, real-world way of thinking about things. But here's the catch, and it's a big one. In the textbook, arbitrage is risk-free. In reality, not so much. See, traders need capital. They need to be able to borrow money. They have to survive long enough for a weird price to actually correct itself. And that's where this whole idea of a perfect market discipline started to show some serious cracks. And this is a really key takeaway. The very people who are supposed to be fixing market mistakes, the arbitrageurs, well, they can run out of money. This means prices can stay wrong for a long, long time. Not because everyone is irrational, but because the rational people are constrained. The market's self-correcting engine, it turns out, is surprisingly fragile. Okay, so if markets aren't perfectly self-correcting, what's going on inside the companies themselves? This led to the next major intellectual shift, turning the lens inward, away from the abstract market, and into the boardroom of the firm. At the very heart of this new perspective was what we call the agency problem. Think about it. The people controlling the money, the managers, aren't the same people who actually own the money, the shareholders. And guess what? Their interests might not always line up. This fundamental conflict changes everything about how a company behaves. This insight completely remade our picture of a corporation. It's not some single-minded, profit-maximizing machine. It's more like a tangled web of competing interests, managers, owners, lenders, all held together by a bunch of contracts. Suddenly, finance wasn't just about picking good projects. It was about navigating power struggles. And this right here, this is the mic drop moment for this whole section. The flow of capital isn't just a simple market story about price. It's a governance story. It's about who has control, who bears the risk, and the answers to those questions, they're buried in the fine print of contracts, not just flashing on a stock ticker. All right, so we've gone from the market to inside the firm, and now the focus zooms out again, this time to the very plumbing of the financial system, the banks, the dealers, the intermediaries that connect everybody and everything. Now we get to a really crucial distinction. On one hand, you have market liquidity. That's how easily you can sell an asset. On the other hand, you have funding liquidity. That's how easily a bank can pay its own bills. The terrifying realization was that these two are locked in this incredibly dangerous dance. And this is how a crisis can spin out of control. It starts when a bank finds it a little harder to get funding, so it's forced to sell some assets to raise cash. But those sales push down prices across the market. That makes all of its other assets less valuable as collateral, which, you guessed it, makes it even harder to get funding. It's a vicious, self-reinforcing downward spiral.
Now we get to the great amplifier, the one force that takes all these other vulnerabilities we've talked about and cranks them up to 11. I'm talking, of course, about leverage.
The most important thing to get about leverage is that it's not neutral. It just pushes things further in the direction they're already going. In the good times, when prices are rising, it makes you feel like a genius. But in the bad times, when prices fall, it forces you to sell, pushing prices down even more. It's an amplifier, for good and, most definitely, for ill. This quote right here captures one of the deepest paradoxes in finance. It means that the periods that feel the safest, when credit is cheap, everyone's optimistic, prices are climbing, that's precisely when the system is quietly planting the seeds of the next crisis by taking on more and more risk. And with that realization, the transformation of finance is almost complete. It was no longer a discipline focused on picking stocks for an individual. It had become macro-financial, a study of the health of the entire system, obsessed with intermediary balance sheets, funding markets, and how small shocks could get amplified into massive, system-wide crises. So let's take a final step back and look at the whole structure we've built. We've journeyed from a really simple, clean foundation to this complex, multi-layered architecture that is modern finance. This progression really tells the story of how finance grew up. Each new layer wasn't a replacement for the old one. It was an addition, built to explain something the previous layer couldn't. The theories got less elegant, sure, but they became so much more realistic. The focus moved from pricing to power, from abstract markets to concrete balance sheets, and ultimately from equilibrium to fragility. And if there's one thing to take away from all this, it's this crucial point. The very features that make our financial system so dynamic and efficient, things like easy liquidity and leverage, are the exact same features that make it so incredibly fragile. Efficiency and fragility are not opposites, they are two sides of the very same coin. We started this by asking how the study of finance transformed. We end with the much bigger, much harder question this new understanding forces us all to face. Now, modern finance doesn't give us an easy answer to this, but what it does give us are the tools, and more importantly, the warnings, to begin to grapple with it.